The financial markets are always unpredictable, but in recent years, big changes in our economy and government had made them, in many ways, more unpredictable than ever. So, what's behind today's market madness? I'm Westwood, the income guy, and you're about to find out. Hi, I'm Westwood, the income guy and founder and president of Wood Financial Group. And for nearly 20 years, I've specialized in helping hardworking Tennesseans just like you reach their retirement goals through income-based financial strategies. And if you're looking for the right solutions to achieve your own financial goals, I can help. Just reach out to me at retiretv.com or by calling our office at 615-826-5749 during today's show or at any time. After the quiet summer that we experienced, the financial markets have gone a little bit crazy since fall has arrived. But historically, that's not unusual. But there are some unusual things about the recent volatility in the markets that highlight how much markets have fundamentally changed in the last decade. And on this show, we're going to talk about what's behind today's market madness and what it means for you as an investor. Today, I'm going to cover what's normal about today's unsettled markets and what isn't, what's driving all current unrest, and how it adds up to being the perfect time to invest for income. And joining me again on this week's show is David Scranton. He's an investing for income specialist with over 30 years of experience, also a best-selling author and a television host. But before we get to Dave, let's look at some of the reasons why the market's recent volatility isn't that unusual and some of the reasons why it is. We do tend to think of October as a scary month, and that's appropriate where the markets are concerned. This thing called the October effect is a common belief that financial declines and market crashes happen the 10th month of every year more than any other ones. And there is some truth to that because there have been some big crashes in October, including the great crash of 1929 that kicked off the Great Depression, and in 1987, the infamous Black Monday happened in October. But on the other hand, Wall Street has enjoyed many strong Octobers, and September has actually shown to have more market turndowns than even October. But all the same, we call the seasonal aspect of today's market madness, normal. Another normal thing is that the fact that the market was due for some type of breather, because except for a few of these sluggish months that we've seen, Wall Street has been on a tear ever since rebounding from the big drop at the start of the coronavirus in March of 2020. It's hit numerous highs, most recently as soon as mid-August. And all this market growth occurred while the economy itself was either in or just starting to recover from the historic recession. Even that seems strange. It is, and it highlights the first several things that are in fact highly unusual about today's market madness. Yes, market shakeups are common in the fall, and yes, hot markets inevitably are going to cool down, and that's all normal, but the extreme hotness of this market in relation to the real economy is not at all, nor is the fact that it's been able to ignore for a long time some issues starting to worry the investors now. And I'm going to talk more in detail about some of those issues in just a minute, but first, allow me to reveal some of the most unusual aspects of today's market madness, today's financial markets, generally speaking. In a nutshell, it is their addiction to the artificial economic tinkering of the Federal Reserve. And I'm going to talk more on that in just a second, but it's such an important issue for investors in or nearing retirement. But right now, you can learn more by reading my timely report, 7 Risks to Your Retirement. It comes with your free retirement income kit, and you can get one of those by visiting retiretv.com or by calling 615-826-5749 and requesting yours. But now, let's welcome David Scranton. David is the founder of Sound Income Strategies and the Retirement Income Store. Hey Dave, thanks for joining me again today.
Well, Wes, great to see you. And it's funny, this thing here called the October effect, right? We all know it's not technically real,
Right.
But in some ways, it almost doesn't matter. It can still affect investors, even though it's not real, right?
That's right. I mean, the October effect, the word has a nice ring to it, I suppose. But actually, if you look at it, as I just mentioned, September has had more down markets than actually October has. But the market is driven by emotion. So even if the October effect isn't necessarily real, it can cause investors to be emotional. And as we know, if investors are optimistic, typically the market's going up. But if investors are pessimistic, typically the markets are going down. So while the October effect may not necessarily be real, just the emotions that it can stir up for investors could cause markets to be very volatile, like we're seeing now.
In addition to that, though, I mean, there are plenty of real factors, too, that can affect investors in the last few months of the year, right?
Mm-hmm. Yeah, not just the emotional ones, but some of the real things that are happening now. Like inflation, or like the unprecedented stimulus that the government has been pumping into the economy. When is that potentially going to end? Interest rates potentially spiking a little bit, but also perhaps higher taxes to corporation under the Biden administration. Many of these real things that are happening right now can have a negative impact to the market, along with some of the emotional things that we're finding.
Yeah, and of course, a real new issue, if you will, is this whole Evergrande issue that happened just a couple weeks ago in China, right?
Right. I think even a lot of domestic investors had no idea about this Evergrande realtor investment company out in China, one of the largest ones in the world. But the concerns with that is that it looked a lot like potentially a Lehman Brothers effect. But fortunately, it hasn't happened that bad. But the idea would be that, hey, if the Evergrande company were to go bankrupt or go financially south, it could cause a ripple effect across the entire economy, similar to what we saw in 2008. And that sure scared the investors in the stock market, because they sure don't want to experience that ever again. But hey, Dave, stay with us, and we're going to talk more in just a moment. But coming up, I'll talk more about fundamental changes in the Federal Reserve since the financial crisis and how they've created a new age of economic uncertainty. Hey, I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor. Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
Hey, welcome back. I'm Wes Wood, the Income Guy, and today we're talking about what's behind today's market madness. So far, we've identified two normal drivers of the recent market spike in volatility: seasonal change and natural timing. The market was overheated due for a cool down, if you think about it. But the fact is, this market has really been overheated for years and increasingly detached from economic realities. So, let's talk about why that is. Going into September, markets have had plenty of reasons to start getting cautious. As Dave and I just talked about, we got inflation, the coronavirus, rising interest rates, and the Evergrande crisis, just to name a few of those. But with the exception of the Evergrande crisis, most of these issues have been making headlines all year long. And while the markets have occasionally wobbled a little bit due to inflation and interest rates, they've shrugged everything off and kept going strong. Matter of fact, from January to mid-August, the Dow added 5,400 points, and all the other indices had similar gains, just like the Dow. Meanwhile, economic data has been mixed, and many areas of the recovery remain really uncertain. Clearly, Wall Street's optimism all year long wasn't based in economic fundamentals like they normally would be. So, what are they based on? Why is the market going up? The same thing it's mainly been based on since 2008, and that is economic steroids injected by the Fed. In other words, artificial stimulus in the form of quantitative easing and near zero short-term interest rates. And as you know, in response to the coronavirus, the Fed launched an open-ended quantitative easing and vowed to hold interest rates near zero through at least the end of this year. It was an announcement that helped the stock market recover from its almost 40% drop at the start of the pandemic just a few months ago, basically ignoring the historical recessions. And this pattern goes all the way back to the financial crisis, when the Fed began injecting the economy with unprecedented levels of stimulus. To some extent, they've really never stopped, and the markets have become dependent on stimulus the way an athlete would become dependent on steroids. And that's the real reason volatility has kicked up this fall, and the reason it will probably continue for the rest of the year, because the Fed is getting closer to raising those rates again and winding down the coronavirus stimulus. And knowing this, investors are suddenly paying attention to a lot of issues they've been ignoring the whole year. So what does this mean for investors in or nearing retirement like you? Well, I'm going to talk about that in just a second. But right now, here's your chance to order your copy of my free report, and it's timely as well, 7 Risks to Your Retirement. It's absolutely free and complimentary with your retirement income kit. And you can get one by visiting retiretv.com or by calling my office directly at 615-826-5749. But for now, let's welcome back income specialist Dave Scranton. Hey Dave, how you doing again?
Hey, doing great. Listen, it's
Good.
It's interesting because you and I both predicted this market addiction due to economic steroids a long, long time ago, even though many seem not to for some reason.
Yep. Yeah, that's true. I mean, just like you had said, and we've had previous conversations years and years ago, when the Fed started just pumping in unprecedented amount of money through dropping interest rates down to zero, and also with quantitative easing, they're just pouring money into the markets and pouring money into the economy. And if you think about it, driving interest rates down to zero, I don't think a lot of people realize really what that does. It encourages borrowing. With rates this low, people can, buy larger houses with less dollars. Businesses can get loans for less interest rates, therefore larger loans for the same amount of maybe financing that they were looking at. And all that's done is just pumped up the market kind of artificially and almost like an athlete would, as I mentioned, taking steroids.
Yeah, and it seems like other than the Evergrande situation more recently, for most of the year, it seems like the only thing that was really even able to spook the markets was this concern about inflation. And even that wasn't that big of a spook.
Yeah, that's true. I mean, we've seen inflation going up a lot, obviously with the large demand and limited supply. But even as the demand has started going down, the supply is not still there because of the limited labor market. So we're still seeing inflation. We even saw inflation kick up so much last year that the cost of living adjustment, Social Security, jumped up nearly 6% going into 2021. And that has spooked the markets a little bit, but not nearly as much as we would have thought. But we're definitely not out of the woods yet by any stretch of the imagination, which is why we're seeing so much volatility. We're still in the midst of coronavirus. We still got inflation. We're still seeing, the government continue to pump money into the markets and into the economy, but that can't last forever. And the big question is what's going to happen when they begin increasing rates and begin taking back some of the economic stimulus.
Yeah, it seems like what's happening right now is we're getting the fear of stagflation because the supply issues still exist, but yet GDP estimates are coming down, the demand seems to be coming down, and that's the definition of stagflation, when you have GDP that's not growing that much, but yet you still have inflation. So, it's interesting. We've seen, some small little market spikes or interest rate spikes over the last year or so. And we might continue to see those small spikes periodically, but I don't know about you, but I don't really see any long-term trend per se of interest rates shooting up in spite of what the Fed would like to do. I don't think they're going to be able to.
No, I think it would be too devastating to the markets and to the economy if they were to really ratchet up interest rates substantially, which is something that obviously they would like to do to try to combat inflation. But even if we do see these short-term spikes in interest rates, which I will get into in the next segment, that really kind of leads us down the path of why it's so important for so many folks that are either entering to retirement or getting close to it to really take a step back and think about what they've got in growth, if they should probably start making a shift to income. And even with interest rates maybe short-term spiking, if they don't go up substantially in the long term, fixed income is going to be the way to go for so many retirees. But Dave, thanks again, and stick around. Coming up, I'll talk more about how today's market madness makes this the perfect time for you to shift, as I mentioned, from growth to income. I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit.
Hey, welcome back. I'm Wes Wood, the Income Guy, and thank you for tuning in to today's show titled, What's Behind Today's Market Madness? So far, we've talked about some of the normal aspects of today's markets and some of the abnormal features triggered by the Federal Reserve. Now, let's talk about what all that means for you. First off, it's important to understand that in many ways, we're in a new age of economic uncertainty. Again, this new age started right after the financial crisis, and that's when the Fed started taking bold measures to try to manipulate the economy. While these artificial measures have had limited effect on the real economy, they've really become the primary driving force behind the stock market continuing to go up. The question is that you should have, is this model really sustainable in the long term? And in many ways, it's as if the Fed and other central banks around the world have been conducting this huge economic lab experiment, and the results of which we really just don't know. For 13 years now, this experiment has helped the markets avoid another long-term market correction like we saw in the year 2000, and then we saw again in the year 2007. And in both cases, the market dropped 50 to 60% and took nearly 6 years to fully recover. But thanks to the Fed steroids, the coronavirus correction that we experienced last March was much less steep, and the economy only took just a few months, as I'd mentioned before. So, is this a new normal? Can the stock market run on steroids forever? Or is there a painful reckoning ahead that will force us to make some fundamental sense again? Again, only time's going to tell. But in the meantime, this age of uncertainty has created some great conditions for income investors for at least 3 reasons. And one of those, it's led to a low interest rate environment that I believe will continue indefinitely, which I'll talk to Dave about in just a second. And that reduces headwinds for bond investors. And when interest rates do temporarily spike, as they have a couple of times this year, the impact that can be greatly minimized in an actively managed income portfolio. And at the same time, an income specialist can make sure your bond and bond-like instruments generate income at a competitive interest rate, even in a low interest rate environment. And that's income you can count on regardless of any changes to your bond values on paper. And 2, if smaller corrections and rapid recoveries do remain normal for the stock market, well, that's going to create some great buying opportunities for investors with the right income-based stock strategies. And finally, if reckoning is in store for the markets, an income strategy is going to protect you from its impact much more effectively than a strategy geared towards growth. And that, of course, is crucial if you're anywhere near retirement or in retirement. But now, before I welcome back Dave, here's another chance to get one of my timely reports, Investing for Income in the Stock Market. And it comes free with your retirement income kit, absolutely free. And you can get one by visiting retiretv.com or call us and request it at 615-826-5749. But now, let's welcome back income specialist and founder of the Retirement Income Store, Dave Scranton. Hello again, Dave.
Yeah, Wes, you mentioned bond investing a few times. And I don't know if you hear this a lot, but to me, a common fallacy that I hear is when people say, well, you should never buy bonds when interest rates are as low as they are today. And that's not really true. It is a fallacy.
Yeah, exactly right. The idea is that, okay, when interest rates are rising, bond values can go down, which there is truth to that. But now as we see it, interest rates are probably going to stay low for a very, very long time. Again, like I talked in a previous segment, if interest rates go up a whole lot, that can have a detrimental impact to even the stock market or to the growth investments. But looking at interest rates staying low for a long time, we could be a lot like Japan that's been in a low interest rate now for 2 decades. But keep in mind, even if we have these short-term spikes in interest rates like we have experienced, an actively managed income portfolio can stay ahead of it and you can still get a great income from your investments.
And if you're in bonds or some of the bond-like instruments, even if interest rates did come up significantly more than you or I think, still your principal is generally protected though. So I think that's another important thing that people tend to lose sight of in the bond world.
Yep, exactly. The income model is great because, hey, even if the value on that bond goes down on paper, the fixed payment of interest stays the same. And for folks that are in retirement or nearing retirement, they realize that income is most important. A lot of my clients that are currently retired and spending the interest from their bonds, they're really not worried about the bond values as much because they know, hey, if they hold the bond until it matures, even if the bond value goes down, they're still going to get that par value back. But along the way, they're going to enjoy a fixed payment of interest that they can use to supplement their income in retirement. So, not as concerned about this idea of interest rates rising, bonds are bad by any stretch of the imagination.
Well, and for those who are really concerned about that, whereas we may not be, they can still invest for income being in common stocks. And granted, it's not a contractual income stream, it can change, but it still puts them in a more stable position than if they were just in growth stocks, right? Oh,
yeah, no doubt about it, because even in investing in the stock market for income, you'll still get those dividend payments from the stocks, and if interest rates are rising and those stocks are continuing to increase, well, you may have a growth component along with the income from them. But keep in mind, an actively managed income portfolio is not going to hold just bonds or just stocks. It's probably going to hold a combination of the universe of income generating investments. An actively managed income portfolio is in most cases prepared for a rising interest rate environment or a spiked interest rate environment. And with the volatility in the market, in investing for income, we can actually take those dollars from the interest and dividend payments, even if the market goes down some, and that creates us some opportunities to potentially buy when the market's down some. Because I know we're talking about a lot of things on today's program that kind of create some market madness, but that's going to give us some opportunities as well.
And today's market madness really is a good example of why investing for income, no matter which way you go, can certainly help one achieve their goals regardless of market conditions for the most part, right?
That's exactly right, because investing for income in the income model, so many people come to me and say, well, you're just investing in bonds, in those instruments. That's not true. There's a whole lot more to the universe of income generating investments. Those stocks that pay dividends for the investors that have the right risk tolerance and those are their goals, even in a volatile market, can be great investments to be in. And for folks that are at or in retirement, if we do have a volatile market like we've mentioned in this whole program, if they're in growth, they're much more susceptible to have a major principal loss in not generating the income. Where the income model, we can get interest in dividends, maybe the values go down some, but that's not the worst thing in the world because we know our income is fixed. But Dave, thank you again for joining us today. And hey, I'm Westwood, the income guy. Thanks for watching. If you have any questions about anything we've covered on today's show, please reach out to me at retiretv.com or by calling us at 615-826-5749.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no obligation conversation with Wes or a Wood Financial Group advisor.